All right, good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for March 8th, 2014. The market is in bullish normal conditions. On an annual basis, using weekly RSI 14, it's overbought with a score of 71 out of 100. Short-term market condition using the 10-day NDX is also overbought at 93 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is white bullish at 9.22%, so about a little over 7% cushion to sideways conditions. Slope of the 50s at yellow neutral at 0.35. ADX improved slightly to 20.3 with the bulls in charge, so still neutral with respect to trend. Although it did get better than last week. ATR percentage at the lower end of normal at 0.87%, so went slightly below the average of the last 6 months. The risk index is the 30-period moving average of the VIX divided by the 10. Anything more than 1 is risk on. Anything less than 1 is risk off in terms of does it pay off to hold riskier assets or not. That reading comes in right now at 1.09, which puts us into risk on conditions. Riskier assets are favored. When you take that score of 1.09 and compare it to the last 5,000 trading days and find the standard deviation and the z-score, comes in with a z-score of 1.05, so slightly outside of normal on the risk on condition. This is the 90-day time series of that indicator. It's just had a nice move from minus 2.5 Z to plus 1 Z. And that's corresponded with a good swing trade in XIV, but points the way to higher prices and reduced volatility going forward. Although we will be aware that it can reverse from this price level here. The easier swing move is over, and so we're being careful now with how we trade the volatility trade intraday. So I would not be using this as a point to start new swing trades in XIV unless we saw the pattern intraday and made some money and decided to hold some of it overnight. So I like to wait for these kinds of extreme turning points before I initiate the swing trade first. In blended monthly rebalancing, you can see the current holdings from 1 March, and then these are the current leaders in the different trading populations. It's still all U.S. all the time in ETF 13. In ETF 22, we've got basic materials and healthcare along with the small caps. In ETF 32, it's the agriculture ETF, healthcare, and basic materials. The winners continue to win in Dow 30. And then the ETF 200 is still being dominated by natural gas and clean energy and biotech. ETF Max, it's still showing strength with coffee, biotech, and solar. In ETF 2, the theoretical exposure remains at 70%. The model portfolio will be at 100% exposed this week. It adds a second position in the European small cap. And I'll explain why when we get to that chart. No real change among the ETF portfolios for blended monthly. You can still see that about 2/3 or 3/4 are on a buy signal compared to their 4-month moving average. The ones that are weak are Japan, Latin America, and emerging markets in the ETF 13. Among the ETF 32, again, it's those it's the international and developing countries that plus Japan that are where the weaknesses are. The main reason that the ETF2 model is the model portfolios at 100% is that the weakness that you see in the indexes is contained pretty exclusively in the emerging markets and the lesser developed countries, and that meanwhile the developed world offers plenty of places to be growing the money and still offer diversification. And so rather than waiting for the truly weak sectors of the world to get above their 4-month moving average, it seems sound policy to allocate money into the areas where where the market is making all-time new highs. I mean, it's shrugging off the Ukraine, and so it makes sense to be exposed in those areas where money's being made. We'll take a quick look at the world market model here now, or the market health check, I should say. The vertical blue lines represent 10, 20, and 30 days worth of look back. And the horizontal red lines are support levels that used to be resistance in the past but have been broken through. And you can see right now the market is comfortably above that previous swing high, which had been the previous all-time high at 185. It's now up at 189. And so that what used to be resistance is now support back here at 185. We have the 10-period regression line steeply up, the 30-period steeply up. The 90-period is still comfortably strong and up. And so this is, continues to be a bullish market in the face of the global tensions. And we have the river is the dark blue shaded area. That's 30-period Bollinger Band plus or minus 1. The floodplain is the lighter blue shaded area, or 30-period Bollinger Band plus or minus 2. We have price comfortably in the middle of that northern floodplain. This pink-looking ribbon is the dragon. That's the 10-period Bollinger Band plus or minus a half. And the dragon has moved from outside the river on the downside to riding the edge of the river on the upside, and that's the position of a very strong bullish move. Has not become a runaway move yet, although it is very, very strong. You notice that the slope function of the 30-period regression line, which I'm tracing here, is this black line. It is now all the way here at 0.40. 0.40 is steeply up as defined by, we look back 5 years and computed the slope of the 30-day regression line for each one of those days, and then computed the average and the plus or minus standard deviation. And so 0.4 is now officially steeply up, and this is the beginning of a strong bullish move up when it reaches that kind of 30-day performance. Now, the last time that it got that high was back here in middle of November, and it pulled all the way back here. That was a function of that's what 30 days of sideways choppy price performance looked like at the end of the last run up to 0.4. And so that would argue for a potential of a consolidation zone here, but it's showing no signs of doing that. And so it's been quite a move here from 174 to 189. You see we had the Z trade here where price came out of the floodplain, touched the -3 Bollinger Band, sharply reversed, broke out of the far side of the river, never even really looked back, and has continued to go. So that's the Z trade on a swing basis in perfect hindsight. So we've been following that all the way up. The percent price oscillator still is open with jaws to the upside. That's still favorable. It's been overbought now for 21 days. It can stay that way for a long time in a bull market. There's no resistance overhead. Because we're above this last swing high resistance, my bias is long, continues to be long. I quickly get onto the long side of the market as soon as I can on the intraday trade on that basis. It's not until price were to pull back into the river here below 185 where I would start to pick up the day-to-day orientation or lose my long side bias, if you will. So this is a market that is still long and strong, favoring the U.S. and Europe and biotech. So the winners will continue to win. This is the ETF2 regional report. 7 out of 10 symbols are on a buy signal, 3 are on cash. Those 3 continue to be the weak areas with Latin America, Japan, and emerging markets. Right now, the S&P is slightly better than the globals at 43 compared to 42. Europe is stronger than the U.S., though. IEV is at 44, with the U.S. at 43. Inside the U.S., the strength has shifted away from the techs for the first time back to the small caps, followed by tech, then mid caps, then the S&P. So 45, then the 44s, then the 43. The 2 strongest sectors that should read IWM and IEV, and the 2 weakest, Latin America at 30 and emerging markets at 34. Inside the U.S. sector spiders of the S&P 500, healthcare continues to dominate, and then XLB has been very strong, and that helps understand how Alcoa has been outperforming the Dow 30 and remains an important swing trade for me. A look at the world market model through this ETF2 lens. Everything U.S. is above average, except for the Dow, which is slightly below average. Everything Europe is above average, with Belgium and Spain exceptionally above average. Japan and Asia less Japan are below average, but when we look at the individual countries, we're seeing clear winners with China and Vietnam, exceptionally above average. Philippines, Indonesia, India, and Australia now above average. Starting to see a little more strength in the Asian countries. This used to be all reds and yellows with only China in the green, but it's looking a little better for the other Asian countries. Latin America, emerging markets, Mexico and Brazil continue to be horrible. Canada slightly below average. In the other asset classes, U.S. real estate and private equity are strong, and all the others slightly below average. So gold and silver still holding their value right now, but not really standing out. And it looks like the market is discounting potential for shooting in the Ukraine that's going to involve anybody outside of the region. In my view, Putin is holding all of the cards. In the business sectors, it's basically a wash between the U.S. and the global counterparts. Healthcare is dominating regardless of where you look, as are materials. Those are the 2 areas that should be the dominant theme continuing to go forward. Canadian dollar exceptionally weak right now. An interesting trade in the U.S. dollar index earlier this week. There was a great big sell-off in the U.S. dollar index, and there may be some value developing there for swing trading and our Forex traders. I'm going to just quickly go to the Dow 30. The winners continue to win: Disney, Merck, Visa, Caterpillar, and American Express. The losers are continuing to lose: Travelers, Coke, AT&T, Procter & Gamble, Walmart, and Chevron. Weakening signals here in Boeing, Exxonmobil, Intel, and United Health because they are yellow on strength and white on consistency. So little to no change among the Dow leaders. ETF liquidity, based on the average daily dollar volume of the last 30 days. These are the 30 most liquid ETFs for trading. And the ones that are in green are exceptionally volatile compared to the stack. So that's going to be the VIX and natural gas. And then everything that's in white under ATR percentage is above average. Yellow is below average, and red is hardly volatile at all. So that gives you just a sense of where places to look for volatility and liquidity for intraday trading. We'll shift to the daily report now. I'm going to concentrate mostly on charts 2 through 5 because those are the primary source for developing the daily plans. No signals in the channeling or overreaction. You can see that the S&P's volatility, as measured by ATR percentage, has pulled all the way back to the 100-day normal. See, the trendiness of the market has started to roll back up, as measured by ADX14, with the bulls clearly in charge. The 10-day winners are the ones that are the 10-day min pains, the ones that have the least pullback from their 10-day high. JP Morgan, Nike, American Express, Goldman Sachs, and Coke. And the 10-day max pains are the ones that might offer some value trades here, since they may have overreacted in their pullback. Cisco, Verizon, Exxonmobil, AT&T, and Boeing. Channeling and overreaction signals in the treasuries, in 551W, silver, utilities, oil, and Exxonmobil. In the auto framer, quite a few now to choose from. These symbols all test out at better than 2-to-1 on the auto framer. I'll be looking at Cliff Natural Resources, CLF, very carefully. It's one of my favorite trading targets, and with a 2-to-1 on the upside inside the basic materials sector, that's definitely one that I want to look at. Looking at the Dow 30, we got a half a dozen dojis, and then here's, let's see, ExxonMobil's 551W. Nothing signals on the RSI2. You have a handful of high fraud quality numbers, so Cisco might be worth looking at, Intel, Travelers, and Chevron. American Express, if we want to reward success here, has had a breakout and closed at a new 10-day, 1-month, 3-month, and 6-month high. As did, let's see, Goldman Sachs gave us a 10-day and 1-month new high. Strong move in Nike and in JP Morgan, both at 10-day and 1-month highs. ExxonMobil, as a 551W, was also a % winner on Friday with a 1.3. And I think we have an intraday trade that we can look at on the frog from last week when we get to the charts of interest. Among the ETFs, the ETF 30, we've got channeling and overreaction here in the treasuries. We've got 3 551Ws with silver, utilities, and oil. Oil testing out at 2-to-1, silver at 2.8-to-1 on the reward to risk. It's also got a frog quality number of 3.3, so that's automatically interesting to me. Looking at RSI2, we do have a signal on treasuries of the score of 8 out of 100, so we'll take a look at the treasuries on a swing basis here shortly. Plenty to choose from in the auto framer, ranging from 4.5-to-1 on Austria, 4.5-to-1 on treasuries. Cliffs Natural Resources almost 4-to-1. Silver at 2.75-to-1. All right, so we'll take a look at charts of interest now. Let me get that queued up. I love this pattern in Cliff's Natural Resources. We have support here at around 1865. We have a clear 10-day high at the far side of the floodplain at 23.5. So that would be our profit target. The dragon has moved from one side of the river down to back to the south side of the river. The last time it did that, and we got an entry signal. Let's see here. The last time this happened, we had a regression line crossover pattern here to the far side of the river, a perfect pattern 1. It failed at the river, and now is at least finding support at the near side of the river, if this works out. So we have Cliff in a critical state. If it fails below 1865, then we have a nice short. But if it finds support here, then we have a trade from 18.5 to 23.5. That's $5 on 18. That's almost a potential 20% move. So we'd be looking for price targets at the Bollinger Band mean, far side of the river, far side of the floodplain, and then the plus 3Z. So that's the framework for Cliff's Natural Resources. And what makes that really attractive is that XLB has been a strong Now, Cliff has been failing while XLB has been working. This is one of the reasons to pay attention to those XL series, the sector spiders. Here's the same time that Cliff Natural Resources had its RLCO. Here's a Z trade in XLB. Only this time, instead of failing at the far side of the river, it took off from 46 and added another couple bucks, an extension on that trade. Now we have the dragon fully on the far side of the river, actually coming out of the river. No resistance overhead. This is still very favorable, probably a reflection of inflation. And but that looks really good. XLB. If we look at the other sector that's really been doing well, the healthcare, XLV. Almost the same pattern, although this has been stronger longer than the materials. Here we have the lazy W pattern, and when it breaks through 57.5, we have this single. And now we have the market, the healthcare is pulled back to the edge of the river, finding support at the dragon. There's another, if it finds support here, there's another move up to 62 is reasonably available. So healthcare is still looking good. Excuse me. We'll take a look at Exxonmobil. This still looks good to me. What we have here is a RLCO pattern. Successfully made it to the far side of the river. Has pulled back and is now finding support at the Bollinger Band mean. If we get a universal entry on this one, we're in good shape. And then if it breaks north of 97, then we have a second leg up, which will take it to 101. So that looks very good. That is a regression line crossover pattern number 2. Successful pattern 1 to the far side of the river, pulls back to the Bollinger Band mean, finding support and taking off. So that's a typical pattern 2 RLCO. You know, the previous move on that one was an RLCO pattern 1 that failed all the way down from 101.5 all the way down to 89. So about a 12% move. And we're halfway back up the stack, and we had a chance to buy in here after the first surge up. So if we miss the first one, the second one just has to find support here and go. Let's see what Alcoa is looking like. I still like Alcoa here, but it's making its second run. It's got to get through this 1220 support level. If it gets above here, I think you can buy it without any remorse. Take a little, yeah. Alcoa is voting north here. If it breaks through, that previous swing high, it's off to the races. I mean, that's a 2-year high that it's breaking up from, so that's very favorable. And on the downside, you're risking, 40 cents, 50 cents down here. So that's going to be an auto buy for me, a second position at 1220. Me gusta. Okay, we'll take a look at silver. Actually, while we're here, we'll take a look at biotech. Biotech is still in good shape here. It has made its second little pullback. So in ETF2, this has me, concerned. My stops are in place. The last time that it made this kind of a pullback here, like this one, it responded with this second leg up. So the first leg up was here, second leg up here. If it stays support above 256, I think you can buy another set here, and it's looking at 290. This is Brazil. This is actually looking healthy. We'll expand this out a little bit. So we have the beginnings of a washout pattern here. We have this long, horrible sell-off, and we've had 2 weeks of positive movement. Now, this looks like it's very healthy, but we got to remember that while Brazil is making this little move inside the box, the U.S. has been breaking out to all-time new highs. So on a relative basis, even though this looks okay, not nearly what the S&P would do. However, in terms of value play, we're really looking at this thing getting back to 51. So if we can get this breakout to continue, there's a move from 40 to 50 available. That's 10 points. So if we just had, if we said we wanted 2 to 1, and we could afford a $5 stop, that means down to 36. That would put a stop down here. And then there's your 2 to 1 on a swing trade. So in my view, if you get it at 42, you have a reasonable target up here about 51-ish. And with a $4 stop, that's a 10% trailing stop. You're not in bad shape there at all. And then we have measured ladders on the way back up. So Brazil is now kind of like officially interesting to me on a swing basis. Okay, we want to look at silver, I think. Yeah. Silver is interesting. After this really nice long consolidation period in here, between 18.5 and 19.5, we had this first move off this bottom to 21, and now it's still holding above what used to be resistance. That could now be support. So this is actually an interesting play here with the idea of targets at 22 and 23.5. Yeah, so that looks like it's got some potential to me. And then on the failure, we would say 1850. So this is actually a pretty interesting area for silver on a swing basis. This is XIV, the inverse volatility. And this is a function, this little pullback here is a function of the Ukraine. But you would have thought it'd been more than that. If it holds here, this looks very promising. Like if the world doesn't go to World War III over the Ukraine. Now suddenly our frame looks like this. Here's the move back to 36, the previous swing high. We have a low here, a higher low here. Even after this pullback, it's still held at right around 29.20. And so in my view, there's a nice swing trade developing in here with an entry around 31.5 with about 1.5 of risk. And then 31.5 to 36 gives you a $4 move. So that's almost a 3-to-1 reward to risk ratio. It does have to get above 33 for that to happen. And so I think this is the tactical trade, is it gets some kind of momentum here and see what it does at 33. If it continues on through 33, I'm going to add a second position with the idea of getting back to 36. So I actually like this. I like this. It's got very strong support down here as well. Okay, so we're about 40 minutes into it. That's all the charts that I wanted to look at. If there's any questions, I'm happy to entertain them real quick. Otherwise, I'll get this recorded and posted. Are there any other charts of interest? If not, it doesn't look like it. So you guys have a good weekend, and we'll see you in the chat room. I want to encourage you to think about coming out to Kansas City for the live research weekend and live trading workshop. It's not filling up as fast as I thought it would. I'm a little surprised by that, given that there were 25 folks that indicated strong interest. And it may be that folks are worried about being able to find research. I am more than willing to turn that into a workshop on the RLCO/frog and focusing on intraday and swing techniques. We can do that. If that's your interest, then the research part of this is simply you doing the work to look at your swing trade patterns and rules and preparing yourself for the live trading that is consistent with the intent of that research weekend, and so we can make it into the workshop that you desire. So take a look at that on the website for details, or if you're interested, give me a shout. We've still got slots available, and I'd like to take best advantage of that time and space. So take good care, and we'll see you in the chat room.